Private markets are undergoing a quiet but dramatic shift. Across Asia, the Middle East, and Africa, regulators are potentially tightening their grip. Limited partners are demanding transparency over massive growth stories, and AI is no longer a bonus. It's the new baseline. The old playbook of capital first and revenue later does not seem to be working. The question now is, who can adapt fast enough to survive in this new order? In this episode of a Global Tech Podcast, we investigate, are private markets across APAC and the Middle East and Africa converging towards a more common regulatory standard, or are they becoming even more fragmented? Are LPs pivoting from pushing higher valuations only to demanding real earnings and even better governance? Is AI expected to drive both product innovation and operational efficiency? Ultimately, what will define the fund managers and founders who thrive in the next decade and have the best exits? To help unpack this and more, a Global Tech Podcast is joined by Bhavik, Vashi, Managing Director for Asia Pacific, Middle East, and Africa at Carta. I don't think there's anybody else out there, frankly, that could have this conversation and that knows what you know about this. Anyway, thank you so much for joining us. How are you doing today?
I am doing wonderful. Thank you for having me, and what an exciting agenda of topics to talk about.
I'm glad you liked it. Okay, as I said, as private markets evolve across Asia, the Middle East, and Africa, shaped by higher regulation, new expectations from LPs, and the rise of AI, what will differentiate the fund managers and founders who will actually thrive? Let's start really high level, and then we'll dig deeper.
Yeah, so I think basics, in my opinion, I think private markets are going through a pretty fundamental shift, as is most of our industry, which is you have technology curve that came in, you have AI, which is a generational technology innovation within that broader technology curve, and then you've got changing economics that have made private markets and alternatives increasingly attractive for investors that are looking to get a return. And so you combine all of those things, and there are a number of things that I think and others might think could differentiate fund managers and founders, as you said, who would thrive. I have a point of view that it's primarily three things. I think the number one thing is really operational mastery, right? So thinking about managers who treat governance, reporting accuracy, portfolio data as core capabilities, not compliance chores, right? Because LP scrutiny is going up, and therefore clean books, real-time visibility are paramount to storytelling, for lack of a better term. I think everybody's got a story to tell, but LPs have become much more smarter and much more discerning in evaluating fund managers. The second one would be AI-enabled productivity. That's true in every industry right now, but it is also true in private markets. So if you think about founders or GPs that build AI into their internal workflows, they're not just investing in AI. That's the expectations, that's table stakes. But are you actually leveraging AI yourself in your internal workflows, whether it be, again, compliance, portfolio monitoring, fund administration, financial planning and forecasting, and scenario modeling, sensitivity analysis? There's a lot you can do. These things allow you to meaningfully run leaner operations, which is important to LPs in terms of the commercials and the economics, and faster, more accurate operations as well, versus private fund managers from even 5-10 years ago who are running primarily on pretty manual, outdated processes. The last piece for this diatribe would be institutional grade discipline, right? It's private funds and companies that perform like public funds and public companies, right? Controls, measured burn, customer economics, transparent cap tables, or fund administration, depending on the context. These are the three things that I think are really differentiating those who thrive, those who survive, and those who don't make it at all. I think making great investment decisions has always been there. These are the new evolutions in the space.
So are you suggesting, because this is actually really interesting, institutional grade discipline, right? Which of course I'm a huge supporter of this. I worked at big institutions for my whole life, right? And are we suggesting now that even some of the smaller funds are saying, even though we have not in the past. We have to behave like we're a gigantic institution because that's the expectation that our LPs are going to have. And then it's also interesting that they're going to use the AI tools to be more productive and act more like an institution. And that gives them the power to do something they couldn't have done before. Do I have that right?
That's right. And I think particularly because it's the smallest fund managers, we call them, emerging fund managers, small cap fund managers that have the biggest obstacle to clear as it relates to actually getting commitments from LPs right now.
Sure.
And now I'm talking about the moment in time. So 2025 November, which is right now. So we think about how LPs have changed the way they expose themselves to private markets. They want more exposure, but they've also been burned by a few very, overvalued, hyped vintages, which are not performing. And interestingly, you're seeing a flight to security from LPs. Even if they want to invest, for example, in venture capital, they now want to invest in Andreessen or Sequoia or Lightspeed
or something, yeah.
Right? Or they want to get exposure to secondaries of OpenAI or Anthropic. The emerging fund manager, the guy or gal that's got a thesis on fintech in Southeast Asia and wants to do a $20 to $40 million fund writing early stage checks into those companies, which, by the way, I think is a highly compelling thesis if you think about the companies and the founders they could be investing in right now, building AI native companies. But counterintuitively, they have the toughest time fundraising. However, technology has progressed. And to your point, institutional grade reporting, compliance, and operations are now accessible to those small fund managers at a fraction of the cost that it used to be. So if you're not using that and leading by example, then I think LPs are smart enough, discerning enough to evaluate you on that, frankly. And so, because it's available, you're not availing it.
But this is actually a really interesting topic. Can we dig a little bit deeper if you don't mind, right? Because it's always been hard for smaller funds, whether it's a $5 million fund or, like you said, a $20 to a $40 million fund, to convince LPs to give them money because it doesn't, I don't know the right word here, but maybe it didn't feel as stable, like that the base there wasn't as stable. And sure, they had a resource problem as well, right? Andreessen Horowitz can have a whole team dedicated to just doing human resources help for their portfolio companies. And a small fund manager can't do it. To be fair, they don't have to because at the stage where they're investing, those kinds of services may not be necessary. But is it a cost problem or is it a confidence problem? Do you know what I mean? And is it bifurcating? Sorry to interrupt you, but is it bifurcating even more now where even if they can use the AI tools to make themselves more productive, they're still thinking it's a volatile time. I just want to be with, like you said, Andreessen Horowitz, just as a proxy. Yeah.
Yeah. So it depends on the lens you think about it. So if you think about the LP lens, in terms of who do I trust with my capital, right? I think that is a confidence thing, not a cost thing, because the economics of investing in any large fund. I don't want to call out Andreessen Horowitz. We love Andreessen Horowitz.
So do we. Yeah. Sorry.
Carta. But they're the best of the best. That's why that's
why they become the proxy
of tissue paper,
exactly.
right? They just, the name represents a large cap firm. But any large firm, the economics are actually disadvantageous to LPs. Let me explain. So if you wanted to think about how they make their money, they get so much more money from the management fees because of how big the assets under management become for them. And as a general partner of one of those firms, your economic upside or your outcomes are less singularly correlated to the carried interest, which relates to the performance of your fund because of how big the fund is. Your carry or your return of your fund is also tightens into a more normal distribution curve because there's little less alpha and a little more beta naturally, because for a large fund like that, you can't do early stage investing, seed checks. Deploying $1 billion of that is borderline impossible based on just actual volume or availability of deals and assets. And so you naturally go into growth investing. When growth investing, you're obviously losing out on more of the upside of that same company if you had invested in it 5 or 7 years before that. there should still be plenty left in terms of getting from growth to IPO or even in the public markets. But the economics, to answer your question, the cost for the LP is higher. I would argue, to go into a bigger fund. It's the confidence which is the issue, because they feel like emotionally and psychologically there's a flight to safety when they've had so many investments go to zero, when you've had certain scandals happen in certain regions. There's not proper governance and visibility, and so you're entrusting a more risky person in their eyes with their capital, which is not liquid, for a long period of time. And since that strategy hasn't seemed to work from a DPI perspective, then they're going risk off. I call it counterintuitive, though, because the whole point of certain asset class exposure, private and alts in general, is actually to seek alpha. And the whole point is to be riskier here because you've already got a large portfolio of publics, bonds, credit, debt, et cetera, that's meant to be less risky in theory. And so it's a very interesting dynamic from an LP lens.
So I think there's something going on actually in the public markets and the private markets at the same time. We don't have to talk about any specific government or any specific actions if you don't want to. But there's been a lot of news recently about, exchanges trying to create more liquidity, trying to create more activity. It almost feels like there's something structural happening there. I haven't been trading in the markets in a while, but that's what I used to do for a living, right? But while I understand the search for alpha, but are there other reasons why fund managers are thinking we need to allocate more money to the private markets, whether it's in Asia or even in the rest of the world, than I am in public markets? Or is it merely just looking for higher returns? And you know the way this works, right? Because the more people that do that, the more the arbitrage disappears. So it's like, who can get there first kind of thing? And anyway, what are you seeing?
Yeah, great question. No simple answer, of course. I think it's a combination of three things. So thing number one is, and again, looking at the last 3 years, public markets in general they reflect the valuation of a public market is much more real time. So you see it spike and you see it correct and dip all in real time in front of our eyes every day, right? And private markets don't. We can get into private market valuations, but they unnaturally hold steady, which is not reflecting what's happening at the underlying asset level, but because of the lack of governance and sometimes the lack of regulation around valuations. What you see from an investor perspective is that this asset was bought at this price and it's been holding that same value for 3 years, which is just can't possibly be true. And so what happens when you have volatile movements in public markets, like we've seen ever since COVID? So if you look at the stock market's rapid ups and downs from 2020 to today, you see spikes, you see dives, you see COVID recovery spike, ZERP era spike, then you see another crash. Like you will see this volatility.
Yeah, the VIX has been on fire, basically.
Exactly. And when that happens from an LP perspective, most LPs allocate still more to public than private. Private is a minority of their overall asset allocation. But when publics, for example, mark down, then they look overexposed to privates because 75% of their pie now just reduced their valuations by 25%. 25% of their pie didn't change valuation at all. Now 25% of the pie is now 30, 40% of the pie.
Right.
Then they say, why are we so overexposed to privates? We should put more money into public. And the inverse happens when public markets take off. So now if we think about today, specifically what has happened, public markets have done very well over the last year, 2 years.
Yeah.
And so that public exposure is starting to look strong again. And they're saying, hey, we could put a little bit more in private. We're overexposed public. And the second thing that's happened is interest rates started to come up, right? Versus they were totally down, then they were up, then they were down again. Now they're really up. And so you start to see that if you really want to beat, just basic savings account or basic Fed funds rate, you really have to get high returns. And where could you possibly get those outliers? Privates, right? You go into riskier asset classes, crypto, venture, you name it, right? And so I think a combination of those two things, plus the facts that in parallel, private markets are becoming more professional. And when a market becomes more professional, it becomes more accessible. All of a sudden, more people can access private markets through various trading platforms, you get, various layers of structure that can give a common accredited investor access to like Series B companies through a series of different companies and structures. And so that's more accessible, it's more interesting, and it's potentially necessary from a portfolio allocation perspective.
So I want to ask you this if you don't mind. You don't have to answer, but I was talking to Arthur Brightman a couple of days ago about something he's building, uranium.io. He thinks that like democratizing access to uranium through tokenization is a good idea. And we can argue whether that's a good idea or not. But tokenization as the thing, uranium.io, you can take a look at. It's actually kind of interesting. He was a fascinating guy, by the way, to talk to. But do you think that, because you were talking about asset allocation between public markets and private markets, and if you'll just give me one more second, I've spent a lot of time thinking about asset allocation between like stocks and bonds and futures and currencies and stuff like that, because you can move in between them with insane liquidity and insane speed. You could do it at dinner. Like nobody would even know you. You know what I mean? It's so easy to do. But today, it feels like it would be hard to move back and forth between public and private in a way that, like you said, if it's 75, 25, but this drops, now this is 35 or 45, it's hard to take money out of here and put it into here. You're just kind of hoping that this goes back up.
That's exactly right.
Is tokenization, and I just thought about it, like, is tokenization a way to say you have access to these private markets, but if we tokenize it, then it becomes more liquid and then you can buy it and sell it in a way that's more effective and efficient? Does that make sense?
Yes, it does make sense. And again, the answer is it could, right? I think so. Again, various nodes of the private market, and I try to generalize so we don't have to be asset class specific. But if you think about the LP or the institutional allocator to the fund or the GP, and then the fund GP to the underlying asset, I think that there is a lot of room for, whether it's tokenized or not, that's a method, a tactic by which to move hands on something.
Sure.
But this concept of, we'll call them LP secondaries, GP stakes, things of that nature, I think there's a tremendous opportunity for that market to be more liquid, because the economic incentives, the level of information symmetry or asymmetry seem much more like solvable problems when it's, to your point, it's one LP wants to get out of private markets and more into public, for example, and another LP wants to get more exposure to private markets and less to public. That's a fair trade. And the GP, importantly, in this particular transaction, shouldn't particularly care or have a strong opinion, because their underlying assets are unaffected. And when you think about valuation and perception, they're more obfuscated away from the reality of the asset. When you look at the same problem from a GP to asset perspective, and in the case of a private equity firm or a venture capital company, that asset is a company, that didn't work. That doesn't work at scale, because a lot of boring stuff, but in terms of like anti-dilution rights on the cap table at the asset level, what does that do as a material transaction or material event in terms of marking the valuation of that asset if it changes hands at a certain price? ROFRs, which generally exist right of first refusal, that allow the company to determine whether that transaction is going to happen or not. There's a lot of, and broadly, I think incentives. The founders or the operators in the company do not want the equity or the shares of their company changing hands willy-nilly
without their knowledge, without their control. Yeah, sorry, go ahead.
Exactly,
because their cap table is really important to them. Sorry to interrupt you.
No, precisely. You're right. It's completely, and even if they have visibility and control to a degree in terms of the right of first refusal, they have carefully crafted their cap table in a way that's strategically valuable and important to them, and they're also managing the valuation and the optics around their company as it grows based on market sentiment, the narratives at the time. And that happens over a very long period of time for any company, 10 years plus. And so because the founders don't want those transactions to happen, it's very difficult for those transactions to happen, versus, again, the GPLP, I think, is very different. So there are different places where we can create more liquidity, or I should say more transferability of private market assets.
I agree. And look, some of my buddies from Morgan Stanley and Goldman Sachs actually moved back to San Francisco and created basically companies that trade I wouldn't even call them I don't know what to call these companies anymore, right? A startup, is that even a thing? But, early stage companies, mid stage companies, and kind of growth companies, but they've created whole businesses around secondaries. But the other thing is it's too slow as well. And I'm curious what you think about this. When I get offered a secondary in a company, I just wonder, like, why are they selling? I know that's not fair,
Sure.
right? Because literally
Sure.
they could have to pay for their kids' college. Like, it could be that
Yeah.
simple, right? They just want to.
Well, it's who's selling as well.
Exactly.
Like
Exactly.
it depends, right? Is it
Yeah.
the founders themselves? That's a different
That's a different story.
worry. Is it an existing investor? Also, probably more worried, but maybe understandable depending on the context. Is it an employee? Very understandable, generally speaking, because of what you said. So that matters a lot. But you don't see that a lot of times. Like when you're trading in secondaries, you don't know where the block came from sometimes, which is another challenge.
And you also don't know why. Can I want to ask you this question, though, because I've been thinking about this private market liquidity for a long time. And I don't know if you and I have spoken about this, but I'm curious what you think. One of the places where liquidity comes from in the public markets, and in particular, and not just in the stock market, but in the bond market as well, and I've traded both of them, is you can sell things you don't own, right? But in the private markets, you can't do that. And I keep thinking there must be a business around creating liquidity by being able to borrow stock and short sell it. Like there should be a whole stock loan, stock borrow business around private equity. Not PE, but you know what I mean? Like equity that's private to create more liquidity because, again, to be fair, then you actually know where the valuation is. This solves the problem, at least we were talking about earlier, where it says, how can it maintain its value for 3 years and it never changes? Where, like you say, interest rate changes, FX rates change, the public markets change.
And the business hopefully is changing.
Yeah,
It's doing something.
Right? Either better, because if it's not, that's also a problem. But what do you
Right.
think about this idea of creating a market for short selling to create some liquidity?
Yeah, I think it's economically viable, or I shouldn't know if it's economically viable or it's structurally viable. The challenge is it a good idea?
Well, short sell, we could spend days arguing about whether short selling itself is a good idea across the board, right? Because
Right.
I mean, yeah,
Right. But then you just you take it like you put some exponential multiplication factor on that when you're short selling something that people have way less information about, way less visibility to. It's completely non-standardized in terms of its reporting, and so
yeah.
in terms of, like, again, information asymmetry as a problem, and then the same things you fear in short selling, or why are people making the trades they are to the 100 on private, right?
Yeah, fair enough.
It's already hard enough just to do, like you said, primary liquidity versus thinking about basically derivative or secondary liquidity.
Interesting. Okay, I'm going to keep thinking about this because this is a business that I've been thinking about for a bunch of years now, and I just want to see if there's a way to do it. Can we talk a little bit more about governance? This was something that I talked about in the intro, but also something that you mentioned too. And because you look at 3 separate regions, I think you have some insight into this that I definitely don't have. Maybe you can talk about, is it different in these 3 regions that you're responsible for? And also what's been changing recently that's driving this focus on governance? Because like you said before, it shouldn't just be like a compliance task. It has to be like a core value of the company, because we've seen, at least particularly in this region where I follow the news super closely, some pretty spectacular blow-ups recently over the last couple of years. Yeah, we don't have to mention who it is because it doesn't really matter. But what is driving it, and do you see differences in the regions that you cover?
Yeah. So I think what's driving it, to answer the first part of your question, in my opinion, is everything we talked about in terms of why is there more interest to participate in private markets, right? So I think they mirror each other, right? Like if there are more people who want to participate in something, the more people that participate, the more regulation, governance, whatever you want to call it, is going to come into play, because now the government has more constituents to either think about, protect, as it relates to the activity that they're trying to conduct, right? That's just how, like, policy works, right? Everybody, totally tangent example, Singapore, everyone's vaping. Now the government feels like it needs to, stop vaping. And so these things tend to happen based on how many people are doing it.
Exactly.
In terms of are there differences? Yes, obviously. I look at Asia Pacific, which is in itself. There's ASEAN with Singapore as a hub, but there's also Hong Kong and Greater China, Japan, Korea, and then there's obviously Oceania, Australia, New Zealand, Middle East, which has its own, but really a lot of activity in UAE and Saudi, and then Africa, which is honestly a mix of a variety of things as well. There are obviously lots of differences based on the maturity stage, for lack of a better term, of each ecosystem. The level of risk appetite, I think, is highly correlated to the strategic ambition of that particular government, and where do they feel like they need to be. For example, I think the governments in the Middle East, and even UAE and Saudi are different, but both in general a bit more risk on as it relates to attracting activity and participation in private capital and frankly all forms of capital activity, because they see this opportunity as the world becomes multipolar to elevate their standing in a new multipolar world where they can play nicely with both China, the US, and everybody else for that matter, frankly. And they have a strategic geolocation that they've always had that they want to tap into. They've always had this energy advantage, and I think they want to diversify away from oil and gas, but they also see the energy opportunity as it relates to AI and technology, whether that's solar or whether that's nuclear. Both they're well positioned to participate in. They understand the economics and the operating models of exporting the world's energy very, very well. And what can they add to that mix strategically is to become an attractive place for capital flows, an attractive place for talent. These are things that are pretty much determined by policy, because if you make it tax efficient, if you make it easy to get a work visa and to live there, then all of a sudden people will come. And then around the people, you can develop the real estate industry, you can build the logistics, you can create the consumer activity, the F&B, hospitality. Like there are playbooks that they have studied from Singapore, for example, Hong Kong back in the day, other places that used to be kind of these, yeah, well, they're the ones who've studied it, right? Dubai and then Abu Dhabi and Riyadh now also competing for that, Doha as well, and many others. So certainly, to answer your question, more risk on, and therefore slightly, uh, uh, I won't say less, but more progressive regulatory regimes, and yes, in some cases, more open, more active in determining their stance on new technology like AI or like crypto, for example, to give two, versus a Singapore, which is more established, culturally different in terms of its conservatism and its views on risk and control and accountability and cleanliness and all of that stuff. They have a very different. They're at a very different stage of their growth curve, and they're also very different culturally. And so, yes, obviously, the regulatory environment, the regulatory environment is different. The governance expectations are even higher.
Yeah, much higher. You brought up Saudi, and again, this is one of these things that I can't stop thinking about. But again, from your perch, are you seeing like interesting things coming out of Saudi, particularly as it relates to, like, I'm just curious what your opinion is about the impact, and I'm not talking about the politics at all because I honestly don't care, but just from a, what is the implication of the PIF's money just coming into the private markets in a way that hasn't happened in the past, at least not to the scale, but also this idea that, again, you said this before, if you look at Abu Dhabi and you look at Dubai, you know, the real estate market, the F&B market, all these things are changed over the last 15 or 20 years because they made a concerted effort to say, you can come here, there's no income tax, it's going to be clean, safe, and beautiful. We're going to be kind of progressive in the way we let you build companies, get visas, and start businesses. And that was a sea change in what was happening in the Middle East. But you're right. Now Doha's doing it in Qatar, and PIF is like the elephant in the room in a good way, not in a bad way, right? Because there's just money coming out of the ground every day, and that's not going to stop. It's just not. So from your perspective, when you look at it, what are some of the implications of that? And you maybe can tie it to exits if you want to, because I want to end on that, because this is something you've been writing about a lot recently. So I wanted to kind of cover that at the end. But what is the implication of what's going on in Saudi? Because it's new.
Yeah, it is new. And you said, we're not going to talk about politics, but we have to acknowledge the fact that the newness of the policy comes from a fairly new leader who has a very strong vision for that country and is making bold decisions relative to any country, but also specifically relative to that country's cultural context and history to change and reform certain things that made that country less accessible or even unfamiliar to Western countries. And by doing that and by making that bet, he is going against certain constituents of his own in favor of what he thinks is best for the country, predominantly around economic development. And that's a reason why that's all happening. What it means, to your point, is it is very significant. I mean, PIF, as an example, and there are other vehicles that they use, is so enormous.
It's enormous.
That it's not just transforming Saudi or the Middle East. It is actually a material source of capital for the global private markets.
Exactly.
Right?
Exactly.
And it's a way of wielding influence and power, frankly, which is when, for example, PIF was, funding all these global private funds and everybody was going to the Middle East to fundraise.
Right? They funded SoftBank for a long time,
100%.
Yep.
And it backstopped basically a lot of the private investing that's happened over the last 5-10 years. Now, when you see a subtle but important shift where they would like to see more of that money benefit Saudi, no surprise there, whether it means, to the fund manager, domicile your fund in Saudi Arabia, and what that means based on their regulatory regime is a certain amount of substance, economic and human capital substance that then has to happen in Saudi Arabia, which creates and transforms the job market there. And then the strings, not only in terms of the domicile of the fund and the fund operations, which is small in the relative private markets, but then the strings that may or may not be attached depending on the vehicle you get it through and the time that you get it, on where that money needs to be deployed in terms of whether it needs to be deployed to either a Saudi company or a company that has business interests or activity in Saudi Arabia. So it could be attracting global companies in. You have that regional HQ program there as well.
Yep.
These shifts don't just move Saudi or the Middle East, they move the world order. And that's, I think that they're very influential. It's very consequential. And I think the exciting thing for us as a software provider, but anybody participating, is that they are actively engaging the world in terms of how best to do that. So they are, they put out open, papers for consultation on what the policy should look like. They think about how they should regulate fund managers, fund administrators, custodianship, what kind of reporting requirements, and they just want to take the best from everyone else. So if they could, okay, Europe does this piece of regulation really well. We like elements of GDPR. We're gonna bring that in as it relates to data sovereignty, but we don't like all this, on the tax side. We really like what Singapore, Dubai, Abu Dhabi have done there. We're going to take a bit of that so they're really just picking and choosing and creating these relationships. None more maybe dramatic than like obviously the Saudi US, partnership and announcements that are put out. It is very consequential, extremely consequential, and I do think it shifts us towards a more multipolar world, which is interesting.
Yeah, and look, I love this idea when a new player comes in at that size, right? Because the impact it can have, as you said, not just on their local market, which is obviously going to be transformational, but on the global market where they're now going out and evaluating, as you said, I love this, where they're taking little bits and pieces from everywhere and saying, what are the good bits, what are the bad bits? And because they're so large, it's going to cause everybody else, I think, at some level to reevaluate how they're behaving and this kind of gets back to the governance thing too. It's like, what should be important to us? Because this gigantic player is going to say that these 5 things in this proportion are the way we're going to do things based on what we've learned because we're new in this game. It's going to make everybody reevaluate as well. Yeah.
And the interesting thing, especially if you think about like a Saudi UAE, just when, because people say the Middle East, but obviously that's got a lot to it as well.
Yeah, it's very different.
The big difference between the two, both countries, as every country does, try to operate in the best interests of themselves, which therefore is the best interest of their constituents. And the difference in constituents is stark, right?
Massive,
the UAE has like somewhere in the range of 1.5 million Emiratis. Those are the core constituents that the UAE government needs to solve for. Saudi Arabia has somewhere in the range of, and the population number keeps changing, 35 to 40 million
people. Yep.
Saudi nationals.
Yep.
And so there's something about that in terms of why this needs to happen. I think the why for them is at a scale that is I would say larger, because we have to diversify away from oil and gas. That's the only thing that we've had going for us for so long. And there's a very clear vision of how they're going to do that in a way that benefits those 35 to 40 million people. And we need to create all the same innovation progression that we've seen, whether it's logistics and e-commerce and healthcare and education and transportation and technology. How do we elevate out of blue collar, first of all, no work to work, and then blue collar work to white collar work. And I think their why is very strong, and they're a very optimistic people and a very optimistic country right now, on various different surveys and research reports I've seen, and they're a young and growing population as well. So when you think of like the demographics, the sociology of it, it's a very interesting, compelling place, and I'm very happy that I've been able to learn much more about it in the past few years, and we've been able to participate in it.
Yeah, look, I want to learn more about it as well. And let's do this. I'm going to end now. I wanted to talk about exits, but I want to leave that for the next time we talk, because I actually think we could do a whole show on just like why exits are becoming important, not just here, but in the other regions that you cover. I'm going to thank you for doing this. Bhavik Vashi, Managing Director for Asia Pacific, Middle East, and Africa at Carta. As always, I hope you enjoyed this as much as I did. Thank you so much for your time.
It is always so much fun. Thank you, Michael, for having me.